All right. I want to say welcome everyone to today's webinar, hosted here, of course, by your one and only Headway Capital. I want to say thanks to everyone for signing up for today's webinar. We had a lot of people sign up for this, which was a little bit of a surprise to me because it's a little bit more of a technical topic. It's we're talking about cap rates today. So, what is a cap rate and why do they even matter? So today I am joined by one of our investor relations associates here, Stephen Tagami. So we're going to have a good time today. We're going to answer questions at the end. So as we're going through these slides, if you see something you have a question about, or if we express one of our opinions and you want us to peel back the onion a little bit more and go a little bit deeper on why we think that, just put it in the Q&A box. We'll be happy to answer any questions you might have. But let's go ahead and dive right in. Let's get started. First of all, a little bit of housekeeping. If you want these slides, you see something you like, you want some more info, just go ahead and text this number, 281-559-7061. You can also email us at investor@headwaycapital.us. Just say, hey, looking for the slides from tonight's presentation. We'll make sure we get that over to you quickly. Another quick disclaimer, this is for educational purposes only. We're not accountants, we're not CPAs, we're not attorneys, we're not tax advisors. We're just giving some education here. We, of course, always recommend that you consult your professional network, whether it be a CPA, financial advisor, or attorney, before you make any type of investment decisions. A little bit about us. My name is Brian. I'm the Director of Investor Relations here at Headway Capital. If it's your first time here and it's your first time hearing about Headway Capital, I want to say welcome. What is Headway Capital? Who are we here at Headway? Our firm was designed to build and protect the wealth of busy professionals. So our goal is to provide passive investment opportunities that give you the freedom to do what matters most in life. Spend time with your family, enjoy mailbox money, as I like to say. So our team has extensive experience sourcing, vetting, and investing in alternative investments through multiple market cycles. That's a fancy way of saying that we focus on one asset class and we're pretty good at it. So our bread and butter is multifamily real estate. You'll see here a few pictures on the screen. First, we got Sid and Anam, a wonderful couple. Sid and Anam married. Sid is the founder and CEO of Headway, launched it, of course, with Anam, his lovely wife, who is a physician by trade. They started investing in real estate back in 2011, 2012, coming out of the great financial crisis back when houses were super cheap and you can get them 50, 60% off. We're able to build their residential portfolio to a pretty sizable feat, and then started passively investing in multifamily real estate back in 2014, 2015, which is what we have a lot of people signed up for this webinar, a lot of passive investors. It's a great way to get started. If you ever plan on being your own operator and running your own deals, that's exactly what they did. And then in 2017, they launched Headway Capital and our property management company as well. And we did our first deal, inviting our investor partners to participate with us. And since then, I will show a little bit more about us, but we've transacted on several thousand units, over $500 million of assets that we've transacted on, and still own about $500 million of assets under management. My name's Brian. I got into real estate in 2017, started in the single family space. I talked to a lot of investors, and I know a lot of people come from the residential space. Got kind of tired and burnt out after a couple of years, even though I was having some success. Transitioned over to multifamily real estate, got educated by watching webinars like this. I was watching 3 or 4 of these things a week. My wife's like, wow, you're watching another webinar. But it's a great way to get education. And it's also a great way to get opinions. So you can start to get different feels for different groups. And then it started into getting into multifamily in 2020. And I did my first deal in 2021 and came over here at Headway a couple of years ago. And now I have the wonderful pleasure of talking to all of our current investors, prospective investors, and all of our partners as well. So have a ton of fun meeting new people and having conversations. And then, Stephen, why don't you go ahead and introduce yourself?
Yeah, my name's Stephen Tagami. I am in the investor relations group here at Headway Capital. I am a engineer by trade during the day, and I help inform and let people know how multifamily works and what it can do for them. So I am super excited to be part of this team.
Awesome. Thanks, Stephen. A little bit about our core values. Won't talk too much about this, but we like to be transparent. We do business with integrity, lean operations. We keep ourselves accountable to our investors and our performance, and we always put our investors first. These core values have helped us with our track record and our success over the last 7 years. So we have over 440 million of assets under management, right around 3,000 units, and we aim for 25 to 30% average annualized return. And we currently have over 500 active investors. And you'll see here on the screen, we've got several testimonials from some of our existing partners that we've worked with over the years that just have a great time working with us and always value our communication and transparency. Again, happy to share these slides with anybody who's looking to learn more about us. So Let's dive right in. I want to hand this over to Steven. He's the man of the hour today. He loves talking about the more technical side of real estate, being an engineer by profession. So, Steven, I'm going to turn it over to you to talk about this, sexy topic of cap rates.
Thank you, Brian. Appreciate the handoff. Yeah, first off, I just wanted to kind of say, I've been talking to a few investors and they've been kind of asking about cap rates and what they are and how they work. And I wanted to go into a deeper dive to let you guys know what it really means and how to infer the number and what, like, if you see I don't know, a 7 cap versus a 3 cap versus a 5 cap versus a 4 cap, like, what does it all mean, right? So first off, just by textbook definition, the cap rate or capitalization rate determines the rate of return for a commercial real estate property. That's a pretty simple definition, but really it's the price that you can sell a property for or that you can buy a property for. It's the value of the actual property. So going through this, we will discuss how to calculate that number. And again, yeah, what it means for you and your portfolio.
Yeah, and we're going to nerd out a little bit. We're going to talk a lot of numbers. So if we got any other mathematicians or engineers on the call, you're going to love this stuff. I do want to highlight on this slide, kind of breaking down like what does it mean a little bit further. The easiest way that I like to think about a cap rate is it would be the return that you would generate if you were to buy a property all cash, right? So if you see something that's a 7 cap, 8 cap, 9 cap, it doesn't factor in the debt element when it comes to property. So one of the things that's really challenging to do when you're valuing real estate, any real estate, not just multifamily, is how do you compare apples to apples, right? You've got properties in different locations and different sizes and different builds and different vintages. Well, cap rates are just one way that you can sort of compare things very similarly because properties that are in the same area, in the same market, same vintage, they should be trading for a very similar cap rate. Here in Houston, for example, a B class, C class property is probably going to trade anywhere around a 6 cap, maybe a little higher in today's market. So you're able to look at two properties that are both 6 caps and compare them apples to apples because they would, theoretically speaking, both generate the same return if you were to buy them all cash with no debt. So I wanted to make sure I highlight that as well. And Steven, why don't you tell us a little bit about how we calculate cap rates?
So the cap rate is a fairly simple calculation, right? It's the net operating income. That's all the money that is generated from the property minus the expenses. So that's rents coming in, that's other income that's generated from the property, and then minus expenses such as capital expenses, normal operation, paying your people to uh, do upkeep for the property, and your taxes, of course. We always got to pay the tax man, and insurance. Make sure that if something happens to the property, that we can fix the property with the efficiency of insurance. Anyways, the net operating income is divided by the current market value. Okay, and so that market value is actually really determined by the rate. And again, like Brian just said, the cap rate is uh, determined by the properties in the area. So a B class property, maybe next door or a few blocks away, just sold for a 5 cap. Your property should be probably around the same value.
Yeah, great explanation. It's a very simple formula. And what we're going to try to do tonight is break down the relationship between each one of these, right? So you've got the cap rate, then you've got the NOI, which is the numerator, and then you've got the current market value of the asset, which is the denominator. What happens to the property's value when the cap rate changes, which is what we've seen over the last several years? We've seen cap rate expansion. What happens to the property when the NOI is impacted? What happens when the NOI goes up? What happens when the NOI goes down? So we're going to break down this formula and get you to understand how powerful of a formula this is because to be quite honest, this is where a lot of the money is made in the cap rate, right? And the thing that you have the most control over as the operator is really one of these things out of these three things. It's the NOI. And we're going to talk a lot about that tonight. But let's go through an example, Stephen, here on so people can better understand what a cap rate, the formula looks like.
Right, right. So again, let's start with the net operating income. Again, that's the amount the property can make. So in this example, we're saying the property, this property in particular, it's an imaginary property. These values are similar to what you might see in today's market, but not exact. Not I'm using round numbers here, But so let's say the net operating income for the year is $300,000, and we know that net operating income for the property because there's history of it. The previous owner should have what's called a T12, which is the trailing 12 months of expenses and income for that property. So we know what that value is, and then we divide it by the current market value to give us a cap rate. Well, like I said before, the cap rate is generally determined by the market. Like Brian said, Houston right now is about five to 6% for Class B property. So I picked out 5%. That 5% will generate a value of $6 million. Okay, so this is kind of a basic calculation, so we can wrap our heads around this. So that means that you could pay $6 million and earn 5% on your money as owning this property outright. Like Brian
Yep.
also said, this is without your debt. This is specifically if you own this property outright. It gives a nice even or a nice number to compare apples to apples with.
Yep, yep. Easy way I like to look at this formula is imagine that you own this property. You've owned it for several years. You're ready to sell, right? You know that your NOI is $300,000. Well, what you're going to do is you're going to go to the broker, the realtor, and say, "Hey, it's ready to sell." The broker is going to tell you, "Well, hey, right now this is about a five cap property, five cap market, right? Based on location, age, all these different elements. This is a five cap. If the broker tells you this is a five cap, it's going to trade for about a five cap, and you know your NOI is $300,000. Well, if you take $300,000, right, and you divide it by 5%, you'll see that you will sell your property for $6 million, right? And it works to both ways, right? Let's say you don't necessarily are concerned about the cap rate, and you know you have a $300,000 NOI, and somebody makes you a $6 million offer, right? They come to you and say, "Hey, I'll give you $6 million for this property." If you divide 300,000 by 6 million, they're offering you a five cap. And that can kind of tell you from a sales standpoint, are they around the right market, right? So if they make you an offer for a higher cap, that actually is not a good thing. If you're selling, you want to sell for a lower cap. So the cap rates are a little tricky, and we're going to break that down where higher cap means you're actually selling for less, and lower cap actually means you're selling for more. And we're going to talk a little bit more about the relationship here on the coming slide. So why does this even matter, Stephen? Why do cap rates, why are they important?
So again, cap rates are used to compare similar properties. We use Brian mentioned Class B, Class A, Class C. So you take a Class A property in the same neighborhood, and you can compare that and use that number to be able to figure out a value, a really quick way to come up with a value for a property. So when you hear somebody say, "Oh, that property is a five cap," you kind of have an idea of, okay, this is a maybe not the best property, but it's not so bad. It's kind of in the middle. Or you kind of get that information when you have a better feel for the market or the area, and you can kind of zoom in on what those numbers like really mean by hearing that number. But it's also an indication of risk. It says how much somebody's willing to pay for the property and for the income that it generates. So in general, a higher cap rate will be a more risky property. It kind of means that somebody is willing to pay less for that property because for the income that it generates, for multiple reasons that we'll kind of get into in the next couple slides. But again, it is a risk. It is a a value, a quick value to look at that you can look at and say determine some risk of the asset.
Yeah. And I think the beautiful thing or sort of the interesting thing about cap rates and use something that I think is very important for all passive investors or active investors to know about as well. And that's risk and how does risk play a role in cap rates. And the funny thing or interesting thing about risk is it's subjective, right? What's risky to me might not be risky to you, and vice versa. So, when you say a higher cap rate tends to mean a property has more risk, well, that isn't necessarily always a bad thing, right? Because if you're buying something that is a high cap rate, that just means it probably has a lot of value add. It probably has a lot of meat on the bone. There's probably a lot of units to renovate. Maybe there's a lot of evictions that need to happen. It needs some work. And your goal in that situation is to turn it around and sell it for a lower cap rate, because you've turned it around. It's not a C class property anymore. Maybe now it's a B class. Maybe C classes are selling for 6.5 caps and five, and B classes are selling for 5.5 caps or 5.75 caps. So turning it around pushes your cap rate down, which increases the value. Well, is that risky? That's subjective, right? Some people will say, yes, that is risky. And I would agree they're right because there's execution risk in the turnaround. There's no guarantee that you're able to renovate all the units successfully. There's no guarantee you're able to increase the rents. There's no guarantee you're able to get rid of all those bad tenants. And you can't change an area, even though you can change a property. If it's in a bad area, you can't do anything about that. But some people would look at it inversely, right? And say that, well, I like the higher cap rate. That means I have more upside. And to me, that's less risky. Well, that's a totally great opinion, right? And the other way around, some people would look at a lower cap rate and say that that's risky because there's nowhere for the cap rate to go but up, right? So, for an example, if you're buying in properties in California, during COVID, right after COVID, California, and it's still an expensive market, but cap rates are very low in places like California because of the attractive nature and job market of California. People want to live there, right? So a multifamily asset that you pick up in Houston and you drop it in California might be a 5.5 cap here. And it might be a 3.5 cap in California, right? And same property, it's just in California. So because it's in a market where cap rates are not as likely to go down, there's arguably some risk there because it could go up, which means your property would decrease in value when you try to sell it if your NOI isn't high enough. But you could go the other way around too, and you can say, well, if it's in a three cap market, that's actually a good thing because if you take $1 of NOI and it's in a three cap market, you've improved the value by $33. One divided by three is 33. So for every $1 of NOI improvement, you've now added $33 of value. How phenomenal is that? Well, in a six cap market like Houston, one divided by six is $16.66. So for every $1 of NOI you create in Houston, you get $16 of value. In a three cap market, you get $33 of value. So there's no right or wrong answer here, right, Stephen? And I think your opinion is your opinion, and your assessment of risk is your assessment of risk. It's just important to understand the correlation and how they work together. Would you agree?
Oh yeah, definitely, definitely. I mean, you have to evaluate these, independently by yourself, a property, and the cap rate helps you do that. And you have to, assess your own risk tolerance and what risk really means to you, right, as an investor. The
Absolutely.
next slide will actually go into actually some examples of comparing different properties and what they and the risk that profiles per cap rate. So this first example, right, we're using the same cap rate equation. We are looking at a cap rate of 3%, right? We're using that $300,000 NOI value that we were using before. And at 3% cap rate, and a $300,000 NOI, that should generate 10 million, or that should be a value of $10 million. Okay. So again, as Brian was mentioning, this is what would probably be a low risk property. This is your Californian property. At the same time, look at that 3%. If you were to invest your money right now in T-bills, what is it right now? 4.5%, Brian?
Yeah, somewhere around there.
Yeah, 4.5%. So, as Brian was talking about risk, is it risky to own a three cap? Maybe. We're leaving some money on the table, right? You can generate 4.5% by just putting into the safest investment you can. So there is some risk in getting into a three cap property, right? You are leaving money on the table. But the property itself will probably be pretty safe in terms of how it generates its income. You'll have great tenants. You can have it's probably a newer property. You won't have any maintenance issues on there. So yeah, that's the 3%. Now let's look at something that has medium risk. Geez. So that let's call that a 5% cap rate, right? So same NOI, that would be a $6 million. That property would be worth $6 million. Now we're calling this guy medium risk, right? It might be a little bit older, 1990s, 1980s vintage, something like that. There's some light upkeep that you have to do, maybe some kitchen replacement, appliance replacements, maybe bathrooms, like really light work on that, right? So there's a little more risk, but it's able to generate some a decent amount of income based on those risk portions to that property. And then, we have the high risk property, which Brian, can you get me
Yep,
a little tick on
there
the
we go.
The marker. There we go. Okay. So we're gonna call this guy a seven cap. Okay. Same NOI, right? $300,000. At a seven cap, it is worth 400 or 4 million $280,000, right? And this might be a higher or sorry, an older property than like 1960s. It might have some major repairs, AC, or chillers, which are major expenses, roofs, just plumbing, electrical, older aluminum wiring, which is expensive to replace and repair. So there are some risks, and you're all probably gonna have not as great tenants. It could be to fill your apartment. It might be harder to fill your apartment with good paying it tenants that always pay their rent on time. So those are the risks you kind of face, and that's why the value is less. Like people are willing to pay less for that harder to manage property. That's just the way it goes there.
Yeah,
Brian,
this
you
is
have
great
anything else to?
points. Great point, Stephen. I mean, the way I like to look at these, and there's a lot of numbers on your screen, and if you're not a numbers person, the top one, the 3%, I would call that more like an A-class property. It's a nice property. It's probably in a nice area. Doesn't have a lot of risk because it's new, which is why the cap rate's low. Then you've got your B-class properties, B plus, B minus, B-class properties. That's probably going to be this 5% cap rate. Then you've got your C class, and probably more, especially if it's a seven cap, it's probably closer to like a D class, which is not something we touch here at Headway, but something that's arguably more risk just because there's more work to do, right? And again, we already talked about how risk is sort of subjective, but it's important to know that the asset class and the quality of the asset often ties to the cap rate, right? So an A class property is always going to have a lower cap rate than a D class property. There's going to be a lot of spread between the A and the D class, right? And the other thing I wanted to highlight on this slide is the NOI on all of these assets is exactly the same. It's $300,000. Look what happens to the cap to the valuation of the property, which is the denominator, the big number you see, when the cap rate changes. So this is why it's very common that value add investors like to buy at a higher cap rate and try to sell at a lower cap rate, because look at the value that gets created by very minimal work. So imagine you bought a property at a 7 cap and you did a bunch of renovations, but you didn't really improve the NOI, but the area got better and the market kind of picked you up because real estate got real sexy, and real and interest rates got pushed down, which is what happened in like 2018, like 2019, 2020, right? The market was a rising tide lifts all boats. Cap rates got compressed. Well, you could have bought a property, did absolutely nothing to it. NOI never changed, and the cap rate went down. Let's say you bought it at a 7 cap and the market over, say, 3 to 5 years drops to a 5 cap. Well, you just sold that property for $6 million and you did absolutely nothing. The rising tide lifted the boats, right? And that's risky, right? You can't assume that cap rates are going to go up, and you can't assume that cap rates are going to go down. Well, I should really say you can assume it's a more conservative approach to assume cap rates will go up. It's a more aggressive approach to assume cap rates are going to go down. So if you buy something at a 5 cap and you assume you're going to sell it at a 4 cap, that's really risky. So what we do when we underwrite deals here at Headway is we assume usually a 10 basis point spread between what we buy it and what we sell it at. So for example, if we buy it at a 5 cap, we're going to assume we sell it at a 5.5 cap in the financial model, just to be conservative, which is kind of a subjective word as well. But that's just our approach, right? We don't want to buy at a 5 cap and assume we're going to sell at a 4 cap, and that's how all the money gets made. That means we're just relying on the market, and we don't plan on executing any type of business plan, right? So I think it's, again, really important to highlight the correlation between the cap rate and the valuation of the property. And a few more examples here, Stephen, on a forced appreciation, which is another angle that we're kind of talking about here.
Right, right. So force appreciation is really improving your property. Okay, so it's again, you have maybe an older property, like we're talking about this Class B property. Some of the amenities are older. We add, we replace the kitchens. We make, we doll up the bathrooms. Everything, make everything look kind of nice, right? And that should attract better renters, and we'll be able to push up rents. And that's really what we try and do here at Headway. But in this example, I'm going to compare, what happens when we change that NOI number? What happens when we can push rents? So let's say we keep, as Brian was saying, we keep the cap rate the same. We don't change the cap rate, it's 5%. in the example we were using before, we were typically using $300,000 NOI. Let's say we're able to push that NOI $50,000. What happens to the denominator? What happens to the value of your property? It went from 6 million to $7 million. That is about a 12% increase in value, right? And that's just by improving your property, making it a better place to live, having people that want to live there, and they're going to pay more to live there. So that is what we do here at Headway, is trying to improve our the value of the property. And you can see the difference between the first calculation and the second. That's $1 million jump based on a $50,000 increase in um, rents and income. Now, what happens if things go the other way? This is detrimental, right? What if you can't? What if you spend money and you can't get more renters, right? Your rental basis goes down. You have to have concessions because nobody wants to live in your property. You're not operating correctly. Uh, so let's say you lose $50,000 on your operations. Now what's your property worth at 5% at a five cap? It's worth $5 million. You essentially have just lost $1 million on your property by doing horrible operations. Is there anything else you think here, Brian?
Yeah, this is so important, guys. So I want to sum this up by highlighting that this slide is really telling that it's very, very, very important that you invest with an experienced operator that has a track record of squeezing juice out of the lemon, has a track record of improving NOI, has a business plan, a legit business plan of adding value to the property and increasing the NOI. Remember, NOI is the income that's, income minus expenses is your NOI, right? So how do you either raise the income while leaving expenses the same, or raise the income ideally while cutting expenses, right? And this property, this slide shows you how much money can almost get created out of thin air, which is the beautiful thing out about real estate. Just by improving your NOI, you'll see in the middle of the slide, right? Let's assume we buy it at a 300K, five cap, it's $6 million. We make $1 million just by adding $50,000 of NOI over a 12-month period, right? So, I mean, it's not an impossible feat to add $50,000 over 12 months with the right size property, which is where a tremendous value gets created. But it's hard to create that value. It's not easy. It's easier said than done. Dealing with tenants, dealing with toilets, dealing with construction, dealing with permitting, dealing with all the frustrations that come with property management. It's much easier said than done, right? So if you deal with an operator that's not experienced in those things and you lose $50,000 of value, and property dropped $1 million just for a $50,000 NOI drop, right? So again, just to summarize, work with the right operator, make sure you're working with somebody experienced, because it'll have a drastic impact on your overall investment when it's time to sell. Let's talk about this last kind of example when it comes to these numbers, Steven. Let's talk about cap rate compression versus expansion, which I know we've kind of highlighted a little bit, but let's just show some examples here.
Right. This is kind of the fun thing that kind of occurs to a property and cap rates in general is cap rates can move just based on the market. Okay. It has nothing to do with the property itself, but the market can change. The demand for that property can change just by what's going on in the market. Just like kind of like the stock market, it'll ebb and flow based on uh, how much, how much free cash flow people have, how much they want to invest. Right. So, when we talk about that, it's like in low interest rate environments, cap rates compress, they go down. More people want to put money into real estate or investments. It's just the nature of how economic cycles work. So either lower cap rates or an increased demand in a property, right? Maybe we hit the jackpot and we buy in an area that has uh, increased demand, like gentrification, right? People might want to start living somewhere. It happens all over the place. And so when we compare that to our bread and butter example, that 5%, $300,000 NOI at $6 million, that 1% compression just boosted our property value to $7,500,000. That's a $1.5 million jump just based on the cap rate compression, based on interest rate, based on demand of the property, based on appetite for real estate. The converse can also happen, right? Maybe interest rates start creeping up. I mean, this is kind of what happened in the last 3 years, right? Interest rates crept up. The cap rates started creeping up. So when that happened, your $6 million property at a five cap just dropped at when it went to a six cap, when people weren't willing to pay for your property as much as they were before. Now just dropped by $1 billion. That's pretty rough. That is not the situation you want to be in. At the same time, we you don't, as an operator, you don't have control of these numbers, but you do have control of when and where you buy, which can, having a good base of knowledge of, what neighborhoods are up and coming, and what maybe you can get some compression in the neighborhood because there's value in that neighborhood, and there's jobs coming in that neighborhood. You could get some compression going on. And also, again, looking at interest rates, making sure that we're on the, I guess, the downward trend, which we kind of are right now, huh, Brian?
Yeah, this slide's really important because this is really an epitome of what's happened the last 3 years, which you even mentioned. Coming out of COVID in 2021, real estate was the greatest thing since sliced bread. Everybody wanted to invest. Cap rates were compressed because of that. So cap rates, I saw some questions flying around, and we'll answer these more specifically, but cap rates are determined by the market, right? It's not a broker that gives you the cap rate. I don't make up the cap rate. The market determines the cap rate based on supply and demand, right? So brokers are in tune with what things are trading at because they see what things are selling for based on their NOI, and they have a massive table, and the lenders do the same thing. So the lenders that are providing the loans to these properties, they know what the cap rates are in every single market, and they'll know if you're overpaying and they'll know if you're underpaying, right? So the cap rate is set by the market. So there's no control on the operator. It's not like the operator can mess up the cap rate and like, oh man, during the hold period, you really messed up that cap rate. Like, not really. The only thing you can really mess up is the NOI, right? Income and expenses. But this will tell you what'll happen. But, real estate's cyclical. It has its cycles, and there's ways to make money in any market cycle. But telling you where we're at right now, I personally am very excited about where we're at because we're at this bottom part right now where cap rates have gone up, which means valuations are down, which means prices are better, right? The best time to buy, in my opinion, is when things are on sale. I like sales. I like going to the store and buying something when it's on sale, right? Like everything's on sale. It's the best time to shop. Unfortunately, for investor psychology, especially when you're newer and you haven't been in real estate for a very long time, you often get what they call FOMO, fear of missing out. Everybody's talking about real estate. It's so amazing. I got to invest now or I'm going to miss out, right? That's usually not the best time to invest because cap rates are compressed. Everybody wants to invest. Interest rates are really low. Money is either cheap or free, meaning when I go to the lender, they're basically willing to give it to me, which is what happened in 2021. Interest rates were, high twos, low threes. That's basically free money. When you looked at inflation, we had negative interest rates, if you think about it. So the best time to invest is when cap rates are, there's no way to time the market. So I want to make sure I highlight that. You're never trying to time the market, but if you can invest when cap rates have gone up, right, and you're buying at a little bit of a higher cap rate, knowing that the market will turn eventually, because these are 3 to 5 year investments. If you can sell at a lower cap rate, you're throwing the cherry on top, right? We're never going to assume we can sell it at a lower cap rate. Again, we've already talked about that. But if cap rates do go down and you've executed your business plan and you've improved NOI, that's how you get these like crazy stories where maybe you've heard like, oh man, I put 100K in and I like 3x my money, which is not what we aim for, but it can happen if cap rates are getting compressed and we execute the business plan, right? So there's just a lot of factors at play here, and knowing what's going on in the market and which strategy to follow is really, really important. Because if you're in a low cap rate market, it doesn't necessarily mean don't invest. People have been buying in California for decades, and it's been a low cap market the entire time. And guess what? They've been making boatloads of money there. So it doesn't mean low cap rate is bad. You just need a different strategy. You need to know how to execute your business plan and have the right type of debt as well going into a low cap market. So um, we'll move on because I can talk about that slide all day. Let's talk a little bit about the limitations of cap rates, Stephen. What are some limitations and some things to think about when you're thinking about cap rates and you're analyzing an investment, maybe that we provide or somebody else provides?
So first off, cap rates are a complete overset simplification of a property's value, right? Like those examples that we used were nice round numbers, made perfect, just trying to give examples of what happens when the cap rates move or when NOI moves to the property or to the value of the property, the value. But there's a lot of nuances in each property, right? Property to property could have a little bit of difference between the quality of residents, and the how many people are actually renting in that property. Your occupancy rates could be a little bit different, which could affect how much you really want to pay for a property. You could have the same amount of NOI for two different properties, and one has a 80% occupancy, and the other has a 90% occupancy. I think you probably want the property that has the 90% occupancy. So there's definitely limitations to how the cap rates are used. The other limitation is it's just a static number, right? We can only look at it at a certain moment in time. So when you buy a property, you basically know that cap rate from the T12 that is provided from the previous owner, and you know how much they made, and so you know the NOI, and you have an idea of what the cap rate should be. So you have that static measurement. But in the future, you don't really know, and that's why Brian has constantly been saying we don't want to when we do our pro formas and when we look at how much of the property should be in the future, we don't look for cap rate compression because that can completely change the numbers and the return for our investors. Also, cap rates are market specific. You can't really use a cap rate for one market, let's say Dallas, versus another Seattle or Los Angeles. They are going to be completely different. That your A class, B class, C class, they don't align. You can't say, oh, I pay a five cap in Dallas and expect that a class A property in Dallas for a five cap. That's not really all aligned. But anyways,
If you
let's say
find
that.
one, let me know
And
where that's at.
yeah, yeah. Sorry, I just got a rambling here, but it's not going to be the same as a five cap. I mean, here's another one, right? Five cap in LA. Would you buy that one?
Absolutely,
Probably.
all day.
Probably like class A five cap in LA all day long, yeah, but you just won't find that. So you can't really compare two different markets. But what it does tell you is an indication of risk, right? You can look at a three cap in California and say that's, again, like for that first example, it's probably gonna be a really good property. And you can look at a cap rate, like a 5% cap rate or 3% cap. Sorry, I'm using all different numbers here. So 5% cap rates start from there in California versus the risk of a five cap in Dallas. And they should have approximately the same risk. It's approximate, right? So that kind of gives you an indication of how much maybe you're tolerant for how much you want to spend for a property. And the other thing it doesn't do is consider debt and leverage, right? So like we just said, the last 3 years, debt has been super high. 4 years, 5 years before that, it was super low. It doesn't take that account, and that's a limitation, and that's also a bonus because we can look at a property just based on its value without the debt. So it's kind of two ways to look at it, but you have to remember it does not include debt or leverage, and that's something you really need to consider when you look at a property. Is that the debt and leverage also on top of looking at the cap rate?
Right. Yeah. So the main summary is the cap rate is just one number, and you shouldn't necessarily get obsessed about is it too high? Is it too low? What is it? Oh, I'm not going to invest because I don't like the cap rate. It's just one variable, but there's so many other variables you need to look at. So you already highlighted, Stephen, that it doesn't include debt and leverage. I mean, you could be buying an amazing property at an amazing cap rate and be putting the wrong debt on it, and the whole thing will fall apart, right? And kind of vice versa. You could be buying a not so great property in a not so great area, put the right debt on it, execute the right business plan, and even though it doesn't look super sexy when you drive by, it can make a ton of money. Right. So it's just one metric. You should understand how it works and you should use it in your analysis to help you make better decisions before you invest in a property. And with that being said, let's talk about the two numbers that I think, just using a little technical lingo here, the two numbers that are most important when you're evaluating a deal. So if you're a passive investor, this is where you want to like take notes, right? Entry cap, exit cap. Let's talk a little bit about those, Stephen.
Right. Right. So entry cap is the cap rate based on the current value of the property, right? So that's what we've been talking about. We look at the T12, we look at the expenses and income, and then the current cap rate of the area, and then we get a value of the property. Okay. That's fairly cut and dry. Okay. Now this is where what do they call it? Financial magic occurs, right?
Hmm.
Changing the cap rate around and making money out of thin air, right? So when we talk about exit cap rate, we're projecting, right? The cap rate is static of today, and we don't know what's going to happen tomorrow. But some people might change that exit cap rate and might change that. to their benefit to make the property look much better than it actually is. So again, in this example, this is pretty similar to what we saw up above. Is this is a cap rate compression just based on value. So if we take the top number as the current value, that's the example we've been using all day long. The 5% cap rate, $6 million property with a 300,000 NOI. That's our, let's call that our entry cap rate. Well, let's say somebody says, hey, I'm going to buy this property. Maybe I do some value add to it and increase the NOI, but let's just keep that constant. And let's say I'm going to say by the time we sell this in 3 years, we're going to have a 4% cap rate. Well, what did that do? That raised our value of the property to $7.5 million. That's saying a 20% gain. That basically doubles your money as an investor just by that magic on paper. That's not real. I mean, that it might happen, it might not. So really, when you look at a pro forma or a prospectus for an investment, I would really look at how the operator is projecting their returns and if they're changing their cap rates on their pro formas.
Absolutely. This is really important to highlight because we have a webinar that we did. It was probably about a year ago. I feel like I need to do it again. Go back on our YouTube channel, look up Headway Capital, and it's the 5 red flags to look for when you're passively investing. Or it might have been 7. I don't remember the number. And one of the things that I talk about that's a big red flag that you need to look for when you're passively investing is what's the entry cap and what's the exit cap and what's the arbitrage in between and what's going on there. So I there are some people who believe the entry cap is not important. It doesn't really matter what your entry level cap rate is. There's some fair arguments to be made about that. And I do have some agreement with that. I'm not saying it's 100% true, but what is more important and what will make or break the investment is the exit cap rate, right? Because if you're assuming that your exit cap rate, what you plan on selling the property for, will be lower than what you paid for it, you buy it at a 5 cap, you think you're going to sell it at a 4 cap, there's arguably risk in that analysis and what it's going to do to the numbers if you're playing with the spreadsheet. It's just going to make it look like it's the best deal ever, right? I don't have to change anything. I don't have to value add. I don't have to renovate units. I don't have to increase rents. I don't have to do any of that BS. I just have to push the cap rate down. Well, guess what? You can't push the cap rate down. It's impossible. So if you see a spreadsheet, or if you don't even need to see a spreadsheet. When you're analyzing a deal, you're looking at the offering memorandum. Anybody who sends you a deal should always have on there what's the entry cap and then what's the exit cap, what's the forecasted exit cap. And again, I don't think the entry cap's as important. It is kind of a gauge of where things are at in the market, and maybe if you're paying a little bit more, a little bit less, but price is important. But what's really important is that you're not making aggressive assumptions with your underwriting and assuming that you're going to push that cap rate down, right? So finding out what the exit cap rate is really important compared to the market, right? So if Houston's a 5 cap market, just using this example, and I send you a deal and it assumes I'm going to sell at a 3 cap, you must tell me I'm absolutely out of my mind, right? So that's crazy. That's overly aggressive. But if it goes the other way and it says I send you a deal and it looks like a 5 cap on paper, and then we're planning on exiting at a 5.5 cap, meaning it went up 50 basis points. That is arguably conservative because we're assuming cap rates will actually expand during the hold period, even though we're implementing our business plan. And if cap rates expand and we still produce all the returns for our investors, well, that's success, because that means if cap rates stay the same or if they compress, we're just going to be throwing the cherry on top in that situation. So we've got lots of questions coming in, so we'll be sure to answer these here at the end. But hopefully that makes sense. Now let's talk about, Steven. Just let's wrap us up here. We got lots of Q&A. Let's talk about conclusions and next steps. What are the key takeaways here?
Right, right. So let's go back, right? So capitalization, the capitalization rate, the cap rate determines the rate of return of the commercial real estate property. That's just the cut and dry explanation. But really, it is it's how we value properties in commercial real estate. Okay, and it's the ability to take one property and another and just quickly do a quick analysis of what's going on there, right? If your risk appetite is a 5 cap, then you're kind of looking in that area for a 5 cap. And so when you see a pro forma, you could say, okay, this property kind of makes sense to me. Now, should it dissuade you from buying property? No, but it gives you just an indication. It's a quick way. It's a quick way of just looking at a property without having to look at the property. So that's the first takeaway, really. It's just a quick evaluation, just looking at a single number. And with property values could be anywhere from like we were saying 6 million, 1 million, 2 million to 50 million, 60 million, 70 million. It really kind of just puts all the value of the property, just kind of makes it really simple to look at. Um, and then also in general, my textbook explanation is higher cap rates mean more risk and potential of losing money. Now, again, Brian's saying that, yeah, it could be, it could, a lower cap rate could be another indication of risk, right? So really kind of finding what you are looking for in terms of that area of cap rate that you are comfortable with. And then the last one, which again is the most important, is really cap rates. It has a lot of limitations, and you shouldn't solely invest on a cap rate. You shouldn't just go out there and say, "Oh, I just bought a five cap and be happy about it." There's a lot underneath that could change the value of that property. Now, some property you can go out and say if the property is worth more and you bought it for less money, and you could be excited about that cap rate, so that's when you're selling and you're selling it for a lower cap rate than you expected, that's kind of a win. So that's kind of when we look at cap rates and compare things, it's like, okay, that was a good cap rate for that property. um so what are the next steps for you guys, right? So, again, when evaluating real estate, know the cap rates for just preliminary screening of the property. Okay. And also in that is remember what Brian's saying and look at the entry and exit cap rates, right? Make sure that we're not making up phantom numbers and we're not making up property gains just based on movement of the cap rate. Uh, with no expect, we don't know the future. Nobody has a crystal ball. Nobody knows that cap rates are going to go down. Right now, we expect them to go down, which should be a tailwind, but we don't know that's going to happen. So, really, when you're looking at investments, make sure that the operator and ask them about it. If you really like the property and they have a different cap rate, ask them about it. Right? Always ask your operator questions. And the last thing is really continue your education. Cap rates. This is just a small slice of what you need to know as a passive investor. I mean, we here at Headway want you to be a really knowledgeable investor. We want you guys to understand these things and not come back to us and like when you invested with us and say well the cap rate was this and now it's this and be upset about what we're telling you right now. We're trying to educate you so you understand what's going on, and maybe you're getting upset of something that's not even a big deal because it's all played out in the numbers. So yeah, you have anything to add, Brian?
Yeah, no, I think great point, Stephen. Cap rates are really important. You must understand the formula. You must understand how they work. We got a lot of questions, so I don't want to go much further than that. We'll be sure to get these answered. But just final statement for me, keep getting educated on cap rates. Understand the cap rate in the market. I'll answer this question. Somebody asked, how do you know what the cap rate is in the market? You got to know that market really, really well because every market has a different cap rate. But make sure you're asking questions about the cap rate if you plan on investing in a deal. What's the entry cap versus the exit cap? You definitely want to see some spread in there as a measure of conservatism or just sort of risk mitigation, right? And just keep getting educated, keep attending these types of webinars. They're going to help make you a smarter investor. So before we get into Q&A, if you're on this call and you're not a part of our private investor clubs, you haven't spoken to me, you haven't spoken to Steven, or you haven't spoken to Sid, please make sure you sign up. These are the people that get access to all of our deals when they come online. We also have member-only in-person events. We do property tours, we do dinners, we do happy hours, educational events like this as well. And of course, you do have to speak to us to get it qualified on this list. So scan this QR code or send me an email if you'd like to get on our list. All we have to do is have a quick 15, 20-minute phone call with me, Steven, or somebody on our team or Sid. And we'll just make sure you're qualified and understand what you're getting into before we show you these types of opportunities. And last but not least, if you're looking for some place to park your money right now and you don't have a deal in front of you, we don't have any open multifamily deals here at Headway. We do have our Headway Income Fund open, which is a hard money lending fund where we go out and provide loans to fix and flip investors, very short-term loans, 6 months or less. We charge them a higher interest rate. The money that we're able to raise and pull from investors, we loan it out at a 13.25% interest rate, and we pay our investors an 8% return for a $100,000 investment. It is semi-liquid. If you put your money in this fund, you can get it back in 90 days or less, and we hold all the first position liens in all of these assets. So worst case scenario, the investor's not able to perform, we take back the house, we finish flipping it, we sell it ourselves. We've never lost any money on any of the deals we've done, and we funded over, the slide's a little outdated, we funded over 1,500 loans so far, and over $300 million. Oh, no, about $285 million, excuse me, of loans in this project. So it's a great way to compound your money investors always get paid first. And these are the returns you can see based on your investment. It starts at 6% for anything under 100K. Anything over 100K pays 8%. You'll see on from there on. So if you want to learn more about this, let me know. You can scan this QR code or you can send me an email at investor@headwaycapital.us or brian@headwaycapital.us. So let's get into the Q&A because we got a lot of questions. I'm going to kind of run through these so we can try to get through them all without taking up any more of anybody's time. I want to try to stay within the hour. So I'll start with this first one here. Who comes up with a cap rate and how do you trust that number? So I'll take this one, Steven. So who comes up with the cap rate? Well, I think I kind of answered that. The market does, right? It's not the sponsor or the broker. It's not a made up number. The cap rate is simply what is the NOI today versus what is the property? What does the seller want in purchase price for the property? But the broker's job is to make sure that the seller isn't crazy, isn't asking for some astronomical price that is outside of the range. So what they do is the brokers, because they do this all day, every day, they're selling properties all, left and right, and they work with the lenders, is they'll say, hey, like if Steven comes to me and I'm a broker and Steven says, hey, I want to sell my property, Brian, what do you think I can get for it? I'm going to ask you what the NOI is. So you tell me what the NOI, I'll ask for your underwriting, I mean, your T12 and your rent roll and all that. But at the end of the day, it comes down to your NOI, and I'll say, hey, what's your NOI? And I'll say, well, right now, properties in this condition, in this valuation, in this area are selling for about a 6 cap, right? So 6 cap, let's divide that by your NOI. Boom, there's your valuation. Here's what I think you can sell your property for. So the market sets the NOI, not the actual, the market sets the cap rate, the entry cap rates, and what the properties sell for, not the actual sponsor. We don't have any control over the cap rate. And this kind of ties into the next one. Do I blindly trust it, or is there a mouth calculation someone can walk you through to trust the cap rate? So, again, it goes back to that. It's not necessarily about trust. The NOI is the cap rate's a formula, right? So if somebody says that they're buying this at a 5 cap, your only homework that you need to do is to find out what are properties trading for in that market. Is 5 cap too low, or is 5 cap too high, or is 5 cap just right? If every property in that exact same condition is trading for a 7 cap and you're buying it for a 5 cap, you're paying too much, right? So the lower the cap rate means you're paying more. So what you need to do is just do some homework. Ask the sponsor, ask the operator. Hey, I see here on the offering memorandum we're buying this for a 5.5 cap. What are properties really trading for in Houston for around this area right now? And then you could do your homework, do your own due diligence, talk to other investors, talk to people in your mentorship group, and see what properties are trading for in the Houston area. That's how you know if you're just right, paying a little too much or paying a little less. But again, the entry cap isn't the end all be all. It's more about the exit cap. So hopefully that answers both those questions. Let's throw one overall to you, Stephen. Somebody asked, how do you calculate the overall gain when the cap rate comes down? I think they were talking about this slide here. I'm going to move back
Right.
here. I'm talking about this
That
right here.
example there.
How do you
Right.
calculate
So
the overall gain?
I just used 6 million over 7.5 million, which is 25 percent or 20% over that change in value.
Yep, it's technically
So
25, but it's okay.
okay.
Yeah. Yeah. So just to answer this question specifically, if you take 7.5 million and you subtract it from 6 million and you divide it by 6 million, you're going to get 25% gain. So another easy way to do this is take 6 million and multiply it times 1.25. You're going to see that it equals 7.5 million. So that's how we came up with this. It's actually 25%. So excuse the typo, but that's how we came up with that gain. It's 25% gain here just by a small move in the cap rate. So a 1% move in the cap rate going from 4 to 5 will equate a 25% gain in the property valuation. Again, that tells you how powerful this formula is here. So hopefully that answers your question. It says this is a question I'll ask you, Stephen. You know your entry cap, but how do you estimate your exit cap rate? What's your take on that?
Right. Again, I think we've been kind of hammering this a little bit, but hey, let's go over it one more time because I think we should be absolutely clear about how this works, right? The exit cap rate is an estimate. It can be anything, right? And it's up to you to determine the value of that property how you see it, right? So we think that you should pick a cap, or the sponsor should actually have either the same or a higher cap rate when they sell on their exit cap rate. If they have lower, again, they are estimating that there's cap rate compression going on, that the property will be worth more tomorrow just based on the current NOI than it is worth today, which it could be true. It might happen, but it doesn't give you a level of safety and conservatism in the underwriting. So we think that's again, like Brian said, it's a red flag. If the cap rate is different than the exit cap rate is different than the entry cap rate. So again, you would like to see, and you can determine this, right? You can determine how much you think that property will be valued during when the operator determines when he wants to sell it, the property. And you can do these numbers all by yourself. But for us, we want to see the same value that you entered at. So if it's a five cap going in, we want to see a five cap going out.
Yep. Yeah, there's a couple of ways to look at this, and this is where a little bit of there's subjectivity that comes in here. So, how do you estimate your exit cap? Stephen kind of hit it, but at the very least, I would say you don't want to see your cap rate lower than when you entered. So, again, if you're entering at a five cap, you don't want to see it lower than a four cap, right? That's one. The second thing I will tell you that's very common practice today, and things change, but as of the recording today, is what we try to do is a 10 basis point spread for every year that we hold the property, right? So hypothetically speaking here, let's say we buy a property today and we buy it at a five cap, plan on holding it for 5 years, 10, 20, 30, 40, 50, right? It's 10 basis points per year. So when we sell the property, our underwriting is going to show that we plan on selling the property at a 5.5 cap. We've added 10 basis points for every year that we plan on holding the property. If it was a 3-year hold, it would be the same thing. It would be 5.3, right? So that's how we forecast, and it's a very common practice in our industry, is a 10 basis point spread. That number could change, right? If we go into a really bad downward spiral, we might go 20 or 25 basis points per year, which is super aggressive. I don't see that happen, but maybe it goes to 15, right? If things get super amazing and money's free again, maybe it goes to 0.05% versus 10, maybe it goes to 5 basis point, not 10 basis points per year. But we always plan on forecasting some cap rate expansion just for the sake of conservatism, and that's how we estimate our cap rate here at Headway. Now, that's a question that I would encourage you to ask every sponsor. If you're on this call and you're looking at lots of sponsors to invest with, you should ask that question on your introductory call, or you should ask that question before you invest in a deal. Tell me how you came up with your exit cap, right? And if they can't answer that question, that's a big red flag, right? They don't know how they came up with their exit cap, but they're not, the whole deal is dependent on the exit cap. That's a problem, right? So we like to use the 10 basis point rule. We also like to look at where the market's at, right? So that's another thing, is the 10 basis point rule may not be a factor depending on where the market's at, right? So if they're buying it at a four cap, which is arguably overpaying when it should be a five cap, but they plan on selling it at a six cap, which is a higher cap, and the deal still pencils, the returns are still there. It's still probably a good deal. Are they overpaying for it? Arguably, right? They're paying a four cap versus a five cap, but they're planning on exiting at a six cap, and it's still producing, I'd say, a 18 to 20% return. Well, I'm interested. If I saw that deal, I'd still be interested. I don't like that maybe they're paying a little too much for it, but if the underwriting has a sound business plan and they're conservative on their exit cap and the returns are still there, I'm willing to take a look, right? So it's just important that you ask those types of questions, know about what the market cap rate is, look to see if they're adding 5 to 10 basis points per year. And if they're not, just ask really smart questions. Would you agree with that, Steven?
100%, 100%.
Awesome.
Always. Well, the last part is always ask questions of your sponsor, right? If
Right.
something doesn't make sense to you, always ask questions.
Right.
That that
Another
is
question
that
just
is
came in. I think this is kind of interesting. I'm curious your take, Steven. This is probably one of our last ones. You said cap rates aren't the end all be all and not the most important metric. What do you think is the most important metric? I think that's kind of a trick question. I'll tell you the other metric that I really like besides cap rates, and I do look at cap rates a lot. I think the other one I like is basis. And like, what the heck is basis, Brian? That's just the price you're paying. The price per door is arguably, in my opinion, it might be my number one measure of whether I want to even keep looking at a deal or not, right? So, and that's because I'm so connected to what's going on in the Houston market. I can very quickly look at a property and go, nope, that's overpriced. Nope, that one's too much. Oh, that one looks pretty good. I like the basis. Let's take a look, right? So, knowing what properties are trading for in the market per door, which is how we value things in the multifamily space, I would think is just as important, if not more important, than your cap rate, right? So, like, for example, if a C class property in Houston is trading between 70 and 80K a door, which is pretty in line with what we're seeing in the market here. And you see a C-class property hit your email box, and it's being bought for 100K a door, they're probably overpaying. Maybe they're from out of state and they don't know what they're supposed to be paying here. Or the inverse, I'll tell you the inverse. It doesn't necessarily mean it's an amazing deal. If I know a C-class property in Houston is trading for 70, 80K a door, like a solid base hit, nice down the fairway, it's going to be not an easy business plan to execute, but it's pretty in line with what's going on. And I see a C-class property for 50,000 a door when everybody else is buying them for 70, you might first be thinking like, "Oh, that's amazing. I want to invest in a deal where they're getting a huge discount." I would ask, "What's wrong with the property?" Instead, because these are very sophisticated investors that sell these things. Most of them are not mom and pop owners. We're buying 150, 200, 300 plus units. These people know what they're doing. They get guidance from brokers. A broker would not let you sell a property for $20,000 a door less unless there was some hair on that deal, right? It's probably got a ton of risk, even though you're buying it at such a attractive basis. You got to ask questions. Would you agree with that, Stephen?
100%. 100%.
Yep. Awesome. Well, we are here at the top of the hour. Somebody did ask, will a replay go out? Yes, we will be sending out a replay. A few more questions here. I'm sorry if I didn't get to your answer question. Please send us an email. So again, just wrap up. I want to thank everyone for attending tonight. Stephen, thanks for being awesome tonight, talking about cap rates. If you have questions for me or Stephen, send us an email. You can use the investor at headwaycapital.us. It'll go to our team. You can also email us directly at brian at headwaycapital.us or Stephen at headwaycapital.us. I want to thank everyone for attending today. We look forward to hosting you on next week's webinar. Be on the lookout for an invite for that, and I hope everyone has a great day.
That was
See
fun,
you,
Brian.
Stephen.
Thank you, man. See
Yep.
ya.